Imagine this for a moment. You've worked hard, you've saved money, and you're ready to invest. But then you ask yourself, where do I start? Should I put my money into mutual funds? Or are ETFs a smarter choice? This question matters because the decision you make today could shape your financial future for decades. In this video, we're going to break it down together. I'll explain what ETFs and mutual funds really are, how they work, their costs, their potential returns, and most importantly, how you can use them to build wealth and move closer to the life you dream about. So why is this so important? Because millions of people invest in mutual funds without realizing that over the long run, they often underperform. They lose valuable growth to hidden fees, trading costs, and management expenses. On the other side, ETFs are gaining popularity worldwide for their simplicity, flexibility, and lower costs. Knowing the difference can literally save you thousands of dollars and years of effort. What exactly are these two options? A mutual fund is like a basket of investments, stocks, bonds, or both, managed by a professional team. You give them your money, they make the decisions, and you pay a fee for that management. It sounds convenient, but convenience comes at a price. An ETF, or exchange-traded fund, is also a basket of investments. The difference is, instead of being actively managed, many ETFs simply track an index, for example, the S&P 500. That means you own a tiny piece of 500 leading U.S. companies, with almost zero effort and usually at a fraction of the cost. Let's talk about costs and commissions. This is where many investors make mistakes. Mutual funds often charge 1% to 2% in annual fees, sometimes more. It doesn't sound like much, but over 20 or 30 years, that fee can eat away tens of thousands of dollars from your portfolio. ETFs, on the other hand, typically cost 0.05% to 0.20% per year. That means more of your money stays invested, compounding, growing for you. What about returns? Here's the truth. Data from the SPIVA reports shows that over 80 to 90% of actively managed mutual funds in the U.S. fail to beat their benchmark, like the S&P 500, over a 10 to 15-year period. Think about that. If you choose a mutual fund at random, chances are very high you'll earn less than just buying an ETF that tracks the S&P 500. And history backs this up. Over the last century, the S&P 500 has returned around 9 to 10% annually. Meanwhile, most mutual funds lag behind because of costs and inefficient management. Flexibility and transparency. ETFs trade on stock exchanges just like shares of Apple or Microsoft. You can buy or sell them anytime during market hours. You see the price in real time. Mutual funds? They only trade once per day, after the market closes, and you don't always know the exact price until later. This flexibility makes ETFs not only cheaper, but also more transparent and easier to handle for modern investors. Stay tuned and make sure to subscribe, because later in this video I'll share a simple, proven strategy that you should start immediately. Let's get back to our video. So, what's the catch? Nothing is perfect. ETFs can be traded too frequently, which tempts some investors to speculate instead of staying long-term. Mutual funds, while often more expensive, do offer the benefit of professional management, which might be comforting if you prefer someone making decisions for you. But here's the bigger problem. Relying blindly on mutual funds means you might be paying too much for too little. The solution? Start by exploring low-cost ETFs that match your goals. For example, if you want to grow steadily with the global economy, consider an ETF that tracks the S&P 500 or a world index. If you want more safety, add bond ETFs. Build your mix based on your risk tolerance and time horizon. Here's a simple strategy to help you get started. 1. Define your goal: retirement, a home, financial freedom. 2. Choose an ETF that tracks a market index, such as, for example, the S&P 500 or NASDAQ 100. 3. Contribute regularly, every month, every paycheck. 4. Keep costs low and avoid emotional trading. This is how ordinary people, not professionals, slowly but surely build extraordinary results. In my other videos, I've shared simulations that will absolutely blow your mind. Let's wrap it up. ETFs and mutual funds are both tools. But tools can either help you build your future or hold you back. The data is clear: lower costs, greater transparency, and long-term outperformance. Make ETFs a powerful choice for most investors. Remember, your financial journey is not about chasing quick wins. It's about steady growth, discipline, and using the right strategies to make your dreams real. So dream big. Imagine the freedom of choosing where to live, what to do, and how to spend your time. That freedom starts with the choices you make today. Do you want to find out how to save more, invest better, and plan concrete goals? If you'd like to know more, subscribe to the channel and watch the next video.